Since 2014, Russia has had one obsession: Fortress Russia. Build a financial wall so high that no Western sanction could ever climb it. And at the center of that wall wasn't the dollar, it wasn't the euro, it was gold. Over a decade, Vladimir Putin's central bank amassed the fifth largest gold hoard on the planet, over 2,300 tons. It was designed as the ultimate insurance policy for a country preparing for a long conflict with the West. But in late 2025 and rolling into 2026, something changed. For the first time in the modern era, that insurance policy is being cashed in. Reports are surfacing that the Kremlin has begun liquidating massive amounts of its physical gold reserves. So what is this really? A strategic move by a disciplined planner using strength at the top? Or the desperate final act of an economy that has run out of room? By the end of this breakdown, you'll see why Russia is selling gold now. Who is buying it? The historical playbook other countries followed when they were forced to sell reserves, and the one signal hidden in this story that may matter more for your savings than for Russia's. Because if a country that built an entire strategy on gold is now liquidating it, you have to ask, what does that say about gold as the ultimate safe haven? The rise of Fortress Russia. To understand the sale, you have to understand the hoard. After the annexation of Crimea in 2014, Russia started a process it called de-dollarization. It sold U.S. treasuries, reduced dollar and euro exposure, and quietly replaced a big chunk of that with physical gold. Why gold? Two main reasons. Sanction-proofing. You can't freeze a gold bar sitting in a Moscow vault. You can freeze a dollar account at a Western bank with one legal order. Sovereignty. Gold is a no-counterparty asset. No SWIFT, no correspondent bank, no offshore jurisdiction. By the time Russia launched the full-scale invasion of Ukraine in 2022, gold made up nearly 25% of its total reserves. Then the West did something unprecedented, froze around $300 billion of Russia's foreign currency reserves. Overnight, the Fortress playbook changed. Those foreign assets were gone in practice. The gold was still there. For roughly 3 years, through sanctions and war, Russia held that gold position. It looked like the perfect hedge. But by the start of 2026, cracks in the fortress started to show. The same gold that was supposed to guarantee independence is now being turned into cash. So was Fortress Russia a genius move or a slow burn trap? You'll see the answer more clearly when we walk through how that hoard was built and how fast it's now being burned. How the hoard was built, 2008 to 2022. This didn't start overnight in 2014. The seeds were planted after the 2008 global financial crisis. In 2008, Russia's official gold reserves were around 500 tons. The crisis exposed how dependent the world was on the dollar system. Moscow started to ask, what happens if that system turns on us? Step by step, 2008 to 2012, steady buying as a diversification move. Gold rose from a minor line item to a meaningful reserve asset. 2014-2016, post-Crimea, Ukraine sanctions hit Russia, accelerated de-dollarization. Large chunks of U.S. treasuries sold. Gold purchases ramped up, often 20 to 25 tons a month. 2017 to 2019, oil revenues strong, budget in decent shape. Russia used the surplus to keep adding to gold. By 2019, reserves passed 2,200 tons. 2020-2021, COVID shock. Brief pause in buying as pandemic uncertainty hit. But Russia emerged with a stronger belief that Western systems could seize or block assets at will. By early 2022, as tanks rolled toward Kyiv, gold holdings, over 2,300 tons, roughly a quarter of all reserves. Messaging from Moscow, we are sanction-proof, we have hard assets. On paper, Fortress Russia looked solid. In practice, it was about to be pushed into a real-world stress test no model had fully captured. The liquidation begins. Here's the bombshell. Russia hasn't just tapped its gold. It has drained most of the gold in one of its key war chests. We're talking about the National Wealth Fund, the NWF. Think of the NWF as Russia's rainy day fund. This is where they park surplus oil and gas revenues for future projects, emergencies, crises. Before the invasion, the NWF held over 400 tons of gold. By November 2025, that was reportedly down to about 173 tons. By early 2026, Estimates say it's even lower. That's roughly 71% of the NWF's gold position gone since the war began. At first, the central bank tried to hide what was really happening. They used a mirror trick. On paper, the central bank bought gold from the government. The government got rubles, cash. The gold stayed in Russian vaults. So it looked like Russia was still fully gold-backed, while the state quietly spent the value. But by late 2025, the central bank admitted something new. It had started selling physical gold on the domestic market. That's a step beyond mere accounting tricks. Why now? 3 big pressures. Oil revenue collapse. In 2025, Russian oil and gas revenues reportedly fell by nearly 25%. Sanctions, price caps, and discounts to India, China ate into earnings. The $75 billion deficit. The budget deficit for 2025 was about 5 times larger than planned. Wartime spending blew past even generous forecasts. The war machine. Military spending now exceeds energy revenues. In simple terms, Russia spends more on war than it earns from oil and gas. The fortress is being eaten from the inside. So the flow looks like this. Oil money drops, deficit blows out, sanctions block easy borrowing. The government turns to the only liquid asset left that still works everywhere: gold. Put bluntly, the war machine is eating the fortress. But if they're burning the furniture to heat the house, at least they're burning it at high prices. That's the paradox. The golden paradox, selling into record highs. Here's the twist. While Russia is forced to sell, it's selling into the strongest gold market in modern history. By early 2026, gold smashes through $2,500, $3,000, then $4,000 per ounce. Selling at $1,200 would be painful. Selling at $4,000 looks smart. This creates a strange optical illusion in Russia's financial statements. They're selling ton after ton, yet the valuation of the gold that remains is still record high. On paper, the fortress still looks impressive. But here's the key line. You can't eat valuation gains. You can only spend what you sell. The fortress is shrinking, even if the line on the spreadsheet still looks big. So who's on the other side of these trades? The answer tells you a lot about how the new gold market really works, and who is happy to buy when a sanction-hit state is forced to sell. The ghost buyers. How Russian gold leaves the map. Russia's gold doesn't just vanish. It crosses borders, often without passing through the old Western hubs. Broadly, there are 3 categories of buyers. 1. Domestic banks. The central bank sells or swaps gold with Russian banks. Those banks gain a real, hard asset. The state gets ruble liquidity to keep, the budget funded, banks solvent, pensions and salaries flowing. In effect, gold becomes an internal collateral engine. It plugs holes in a banking system cut off from Western dollar funding. 2. The shadow market. Dubai, Hong Kong, Turkey. Before sanctions, a lot of Russian gold ended up, refined to London good delivery standards, cleared through London Bullion Market Association channels. Now, new mine output, roughly 300 tons a year, is being redirected through Dubai, UAE, Hong Kong, Turkey, occasionally via smaller regional hubs. This flow often works like this. Gold leaves Russia, gets refined or restamped in another jurisdiction, then quietly enters global supply as non-Russian metal. Western refiners might avoid Russian origin, but global demand doesn't care as long as form and assay are acceptable. This is why you're not seeing a flood in London prices, even though Russia is selling. A lot of the volume is bypassing Western paper benchmarks. 3. The individual Russian citizen. The Kremlin has taken an unusual step for a major state. It openly encourages citizens to buy physical gold. Banks offer gold bars and coins. Ads pitch gold as a way to protect savings. This does 2 things. Gives households a perceived safety valve. Lets the state convert gold into rubles while keeping metal inside the Russian population. It's a kind of internal nationalization by diffusion. The state hoard shrinks, private stacks grow. The total gold inside Russia might not fall as fast as the official number. But if finances get worse, history suggests an ugly next question. Does the state later declare that privately held gold is a strategic asset that must be contributed to the national effort? That has happened before in other countries. We're not there yet, but the script is familiar enough that it's worth noting. Forced gold sales. Russia is not the first. It's tempting to see Russia as unique, but there's a longer pattern of states forced to sell gold when their strategies break. A few examples. United Kingdom, late 1990s, Brown's bottom. The UK sold about 400 tons of gold between 1999 and 2002. It did so at some of the lowest prices in modern history. The sale was politically spun as modernizing reserves. In reality, it became a textbook case of a major power selling low IMF gold sales. 2009-2010. The International Monetary Fund sold over 400 tons, framed as restructuring its balance sheet and helping low-income countries. The sales happened just before gold began its final surge toward 2011 highs. Italy and Eurozone debate. Periodically, during European debt scares, politicians floated the idea of using Italy's large gold reserves. The mere talk of using that gold signaled how strained the system was. The pattern. Gold is accumulated in stable times, framed as prudence, then sold under stress, framed as rebalancing or modernization. In hindsight, those sales often look badly timed or politically forced. Russia's position is more extreme. It's at war. It's under heavy sanctions. Its oil discounts are hurting revenues. It is isolated from Western debt markets. So the sales are not just about portfolio rebalancing, they are about survival. That's the key lesson. Even states that love gold end up selling when fiscal and political reality corner them. Which leads to a simple, uncomfortable conclusion for individual investors. Gold can be a great hedge, but if you run your personal finances like a government, overspending, overpromising, it will eventually get sold at a time you don't choose. The endgame. How long can this last? So how long does the fortress have before the walls are too thin to matter? Analysts looking at Russia's numbers estimate something like this. At a burn rate of roughly 12.8 billion rubles a day in asset sales, liquid reserves could be heavily depleted by mid-2026. If that happens, the Kremlin is left with only a few solutions, none of them good. Print money, turn on the presses, monetize deficits. This pushes inflation higher, already creeping toward 15% in some estimates. Massive tax hikes. Squeeze households and businesses harder. Risk a deeper recession and social pushback. Cut military spending. The cleanest economic move, but politically? There's been zero sign Putin is willing to scale down the war machine. So Russia's gold standard era from 2014 to 2022, where gold accumulation was the core policy, has now become a gold liquidation era. They spent a decade building a fortress out of bars. Now they're pulling those bars out one by one and feeding them into the furnace. That buys time. But it also means the fortress cannot look the same 3 years from now, no matter what the PowerPoint slides say. The real curiosity is this. What happens if Russia crosses the line and starts drawing down the 2,300-ton central bank hoard, not just the NWF? That's where the global implications turn from large to seismic. What this signals to the world. Russia's gold sale sends a message far beyond Moscow. It proves a few uncomfortable truths. Even massive reserves have a breaking point. You can't fight sanctions, war, recession, and demographics forever with a static pile of metal. Fortress strategies work until the siege lasts longer than your supplies. For the global gold market, this is a strange moment. On one side, Russia is a forced seller, adding supply. On the other, global fear, de-dollarization, and central bank buying are driving record demand. So far, the fear trade and non-Western central banks have easily absorbed what Russia has sold. But if Russia finishes liquidating the National Wealth Fund gold, and then seriously taps into the core central bank hoard of over 2,300 tons, the world could see sudden surges in physical flows into non-Western hubs, Western benchmarks, like London spot, decoupling even further from real delivery prices, volatility spikes in gold that rival or exceed the 1970s. Fortress Russia isn't gone yet, but the gold at its foundations is being chipped away, bar by bar. And that leads to the question that matters for you. What this means for you. 3 scenarios. You're not running a war economy. You're not managing a central bank. So what does any of this mean at the personal level? Think in scenarios. Scenario 1. Short, sharp crisis. West dips into a recession. Fed cuts, then hesitates. Markets wobble, but no major war escalation. In this case, gold remains a portfolio hedge. Russia's sales are mostly absorbed by global demand. Volatility is high, but the long-term case stays intact. If you're a trader, expect more violent moves around macro events. Russia's flows add noise, not trend. If you're a long-term holder, this is where you verify why you own gold. Hedge, not lottery ticket. Scenario 2. Prolonged standoff and resource war. Ukraine war drags on, Iran risk spikes. Energy and metals are openly used as economic weapons. In this case, gold and critical commodities stop being just assets. They become part of national security toolkits. That means more price floors, more capital controls, more chatter about excess private holdings in some countries. Physical holders may do well on price, but access and tax risk can rise dramatically. Owning something valuable in a world of desperate governments is a double-edged sword. Scenario 3. Major currency regime shift. Trust in U.S. debt weakens. De-dollarization accelerates. A new BRIC-style trade unit partially linked to gold or commodities emerges. In this case, gold stays central, but its role shifts. It's not just a hedge, it's a settlement backbone. For individuals, physical metal is less about number go up, more about being on the right side of a monetary reset. The Russia story then becomes a case study. They had the metal, but their policy choices forced them to burn it. The takeaway is simple. Gold can protect you. It cannot save you from your own budget and politics. At the personal level, don't copy the one good thing a state did, buy gold, and then also copy all the bad things, overspend, overextend, rely on miracles. RateScope here. If Russia's gold liquidation proves anything, it's this. Gold is real. It buys time. It doesn't remove consequences forever. If this helped you see gold as part of the story, not the whole solution, hit like so more people get the context behind the headlines. Subscribe to RateScope if you want more breakdowns of what governments actually do with their reserves, not just what they say in press conferences. The headlines show you record reserves. The fine print shows you when those reserves are quietly bleeding out. Stay with the fine print. This isn't financial advice, just the part of the story you're not supposed to sleep through.